So many people are into debt trap. Many people are into heavy liabilities. People think that they have assets, but they do not calculate their liabilities. Many people really don't understand what risk also is. And believe me, not all goals are hunky-dory. People are already in a mess.
Kalpesh Ashar is a certified financial planner and SEBI-registered investment advisor. With over 15 years of experience, he has been instrumental in helping individuals achieve their financial goals.
So what are some of the other classic mistakes that investors make when it comes to asset allocation?
These classic mistakes are nothing but behavioral mistakes. It's human nature which is the biggest obstacle to letting a person achieve his financial goals.
So if you could provide the pecking order of different asset classes and which would be the best as a hedge against inflation?
Obviously, takes the top slot. Second, I would look at candidate for the third spot. Could be a... And...
Hi, Kalpesh, let's talk about, asset allocation. But before we do that, why don't we pull the lens out? This is Personal Finance TV after all. So let's talk about personal finance and what exactly that means when it comes to asset allocation, because you've stressed on the importance of goal setting.
Absolutely, Awan, and thanks for having me here. Like what you rightly said, I've always believed that when you speak about the concept of personal finance, the stress should be on the word personal. And finance is by default going to happen. And when you set the context of a term which is very, very, I think, abundantly used in finance and, when you talk about financial planning is asset allocation, which I believe is very, very integral when you are preparing a financial plan for your clients or for any individual, because asset allocation is the crux, is the root, is the way in which the client achieves his goals. And that is where I would probably differentiate asset allocation of the financial planning route rather than the textbook concept of asset allocation. Because there cannot be a thumb rule, I believe very strongly, that a fixed percentage of assets distributed amongst various products or asset classes can give you the final bliss or help attain a client nirvana. Because every client, every individual is on his financial journey of his own.
Okay.
And as an advisor, which product, which asset, in what proportion, in what time frame is suitable for the client to help him or her achieve their financial goal, I think that is the crux, and that is where I would marry the terms asset allocation with personal finance.
You spoke about financial nirvana. That is hard to achieve, is it not?
Very hard.
Yeah. But of course, it differs from person to person. But would there be, you're stressing on the importance of goal setting. So what is the checklist that individuals need to get out when they're talking about managing their personal finances? What are the key terms? What are the key numbers that they need to look at?
So let's start with the heart of financial planning, which I personally believe is nothing but financial goals. Because when you attain financial goals, what you've done is you've given purpose for your income and your expenses to help you achieve those goals. And when I say financial nirvana, don't get me wrong, I'm not saying financial independence.
Okay.
I'm saying that the bliss or the sense of achievement which a client gets when he achieves a particular goal, for me, that's financial nirvana.
Okay.
And that could be a whole journey of goals which a client gets to. Now, how's the journey? Like exactly your question. First and foremost is the definition of financial planning. Let's get that context right.
Okay.
It's a very simple definition. For me, it's nothing but managing your existing lifestyle, overcoming the financial obstacles which come in a day-to-day life, which are bound to happen, and more importantly, achieving or planning your future goals simultaneously. So put all these things on one particular, segment. That is personal financial planning for me. And everyone's story is different. So the first important part which we are taught in the textbook of financial planning is understanding your cash flow.
Okay.
Very, very important. That people are really not aware also.
Yeah.
And as a matter of fact, I'm talking as a practicing CFP. how much their expenses are.
Yeah.
Income might be known to you if you're salaried.
Okay.
So expenses on a day-to-day basis, the couple or the nucleus family, they've probably never put, pen to paper and jotted down what are their monthly expenses.
Yes.
And yet they might be smiling.
Yeah.
Whereas they might be in a negative cash flow.
Yes.
So setting that, I think, is the first thing, right?
Okay.
Second, I would assume is understanding their existing net worth.
Mm-hmm.
Many people do not know where their assets are spread. Have they invested in the right products? Is that product suitable for them? Are they paying a heavy price for that?
Yeah.
Is it liquid? So setting those assets in order is necessary. Then comes your liabilities. People think that they have assets, but they do not calculate their liabilities. Because assets minus liabilities then would get to your net worth. So that personal balance sheet is the second step. Third is the financial goals, which I feel is the heart of financial planning. Because if you have your monthly cash flow in place, if you have your assets in place, your liabilities taken care of, then setting realistic financial goals and helping those, I would say the weapons or the ammunition to help you achieve those goals is the crux.
Yeah.
The next point is, if all this was so simple and was so easy, then you did not foresee any risks. Now, how do you manage those risks? Which is nothing but risk management, and that is done through appropriate insurance. Because there could be a financial emergency, there could be a loss, there could be you need to be equipped against it. There could be human life loss, there could be medical contingencies, there could be contingency fund which you have to keep. So protecting yourself against that. So put all these things together and put your goal in between. Automatically financial planning happens. And that is where the advisor comes into the picture. He collates all those things together, sees the view from a 360 degree, and advises the client to help him achieve his goals. And believe me, not all goals are hunky-dory. People are already in a mess. People have to be removed from that. Even that is a goal. It's not that everything is fine and you're just aiming for the near future and the future. The goal is clear. So many people are into debt trap. Many people are into heavy liabilities. How to get that out also is an integral part for a financial advisor. So that's what I would summarize as personal financial planning is.
All right, now let's talk about asset allocation. What are some of the factors that investors need to consider when they are allocating across the different asset classes?
Okay, again, I follow the principle of the KISS formula, which is keep it simple and straight. Okay. And when we talk about the simple asset allocation, I would just like to go into two terminologies. First, understand your time frame. First and foremost, please understand the time frame and divide your assets accordingly. Because if your time frame is determined, you will not fluctuate, you will not panic, and you will not take, I would say, hasty or panicky decisions while selecting the right asset class and live with it. That is more important. So when you say time frame, what are time frames? So we would like to classify it into short term, medium term, and long term. And here I'm talking about achieving certain goals. I'll keep harping about goals, and goals. Okay, because that is what I believe would give the client ultimate satisfaction as to what he or she wants to achieve. So when you say short term, I would say any goal which a person wants to achieve, anything starting from tomorrow till the next 3 years is a short term goal. Anything a client wants to achieve from, say, 3 to 5 years is a medium term goal. And anything beyond 5 years is a long term goal. These are 3 buckets which we are creating. And it's very simple. Now, when you say short term, it means that you have to attain something in that very, very, shorter period. You don't have a scope or a chance of taking a risk. And you cannot lose that amount because you don't have time to repair it or resurrect it again if that time is lost. What do? Simple logic is you go in for conventional fixed income products. So if you have assets which are in the fixed income category, and here I'm talking about your debt-based mutual funds, even conventional bank FDs, even your, some short-term post office schemes which you have, so on and so forth, which has got basically a sense of security, which has got a limited interest rate, earning scope, and most importantly, are liquid. Because you don't have the chance to lose on the amount in the short term. Now, once you have that set, you know that your goal is secure. Next, you move to medium term, which is 3 to 5 years. There you have some time on your hand and also have some scope to earn a little bit more than the fixed income products, because the time frame has been broadened out there. Here you have a scope of probably putting, now this is not a textbook rule, I'm just giving a broad framework. You have a scope of putting around 60 to 70% in fixed income, but the remaining 30 to 40% can go into a hybrid type of a product, which is a mix of debt and equity. So that is the second period which we're talking about. And obviously, the third one is the long term, where you need a blend of high growth, a little bit of risk-taking asset, and also an element of safety, because you have time on your hand. So if you have that 5 years and above, the obvious answer is the chunk of that allocation would go to equity-based products. I've still not named any products. I've said equity as an asset class out here. And more importantly, some element of safety, just to like a hedge type of a thing. So that 10 to 20% can be kept there. Now, understand the I would say the implications of all these. If today a client comes and he or she says that these are my goals, and I have apportioned those assets in these three things, even if today the market collapses, I'm talking about the equity markets, because subject to volatility, he will be sleeping well, because I have told him, and he has more importantly told me, that he's not going to require this money for the next 5 years. Second is, even if the market collapses and his short-term goal is near, again, he'll be comforted because he's got that money secure to do what it's supposed to do. It's simple logic.
Okay.
And in any case, your investment should be liquid. So just to quote an example, it might sound outlandish. When you say something like a short-term goal, or say even a contingency fund, I've heard people saying that. Say that if you tell people that you should keep 6 months of your expenses kept aside as contingency, and you should be able to tap onto it. I've heard people saying that no problem, I've got some real estate with me. But that's as ridiculous a statement it can be, because they are trying to tag or link an asset class which is highly illiquid to something which they require anytime.
Yeah.
Now that's wrong asset allocation.
Yeah.
So if these parameters are met, I don't think it's a no-brainer that anybody would sleep well at night. Obviously, there is monitoring to be done, there is reviews to be done, there is, constant check to be had. But more or less, you are on the right path.
So what are some of the other classic mistakes that investors make when it comes to asset allocation?
A good question, Avan. And these classic mistakes are nothing but behavioral mistakes. Okay, the advisor has done his job probably, but the investor is human after all. And when I say human, you automatically attach that with behavior. And the biggest one here is that the fixed income instruments, let's put it that way, the short-term goals, they are not supposed to give you higher returns, because they're not in that category which is supposed to yield higher returns. Now, what sets in here is the element of a person or an investor getting bored. Saying that he has started off on a journey saying that, no, I'll stick to this. But when he sees that, this is still yielding me, and he's been told, but it's human trait that this is not giving more than 5 to 6%. And for example, the equity markets are doing well. He's bound to have an attraction or a lure saying that, oh, why can't I flip here? And if not for an advisor who's going to handhold him tightly. He's going to flip. That's a mistake, because that he's jeopardizing his own goal out there. Second is the complete contradiction of that is in the equity space. Now, you've told somebody that you have to stay put for 5, 10, 15 years because that's a long-term goal. And equity markets are subject to huge, fluctuations. And what if that cycle, the markets are doing nothing? And you have a cycle where, say, an asset class like fixed income or gold is doing well. So there he might be probably in a break-even or a negative space for some time, which is the nature of equity. He'll be again compelled to take a decision, which is in the short term, he'll flip to fixed income and thereby jeopardizing his compounding, which is going to happen in the equity space, as in when the markets rise. We don't know. But he's jeopardizing his own contradiction, which is there. So the point what I'm trying to make is that these are all attributed to human behavior. And probably there's an, I would say an explosion of knowledge or explosion of happenings today in the world that it's difficult for a person to stay put on his own financial purpose or goal, that he keeps hearing things from here and there and he forgets what he's actually set out to do. The point is, it's human nature, I think, which is the biggest obstacle to letting a person achieve his financial goals.
So how much would you say, the EQ has a role to play, or behavioral aspects have a role to play when it comes to financial planning?
Oh, huge.
Yeah.
I think absolutely necessary, because that...
Can you give any examples? Maybe?
Yeah. So let's say that that person has never been tuned to a financial plan concept at all. And he has always been tuned to hearing market returns. He's always been brought up in a culture, probably in his family. Now I'm pointing out different features in his family, that a particular asset class is good for the family. So you have here a genetic problem where the family, the father, the grandfather and the mother have always been talking about a particular asset class and deeming it to be the holy asset class that to go to. And if you do anything else, you're committing a sin. So you have conventional families talking about gold hi lena hai, that real estate is the place to go. Other people might say that, the best place is equity. And you as a child have grown up listening to that and you've created a bias. So these biases are the ones which are the biggest problem to a financial plan. So this is one of the classical case which we have, that people have entrenched themselves in a certain bias or a certain mindset, which is very difficult to get out. Second is, people link their existing profile with themselves deciding whether this is the right time to start financial planning or no. So many people come to say that, I don't have sufficient resources right now. Why should I start my financial planning? Not understanding the fact that sooner the better it is for them, that they understand their mistakes, they establish their goals, and they do not procrastinate.
Yeah.
The other bias is what we call, in a very textbook manner, is the herd bias, that everyone is doing something, even I have to do that. FOMO.
Yeah.
Now, that's not a financial planning bias, but it's an investment bias. And that's what, really tracks the whole plan. If you have made a plan for something. And again, it's all boiling down to behavior. So that's why when you ask the question, that human behavior, I think, is the biggest, I would say, ally and an obstacle as well to financial planning.
It's your friend and your foe as well.
Both.
Yes.
Both.
If I were to sort of read between the lines of what you said, assuming people have more long-term goals, does that mean that allocation to equities should be a little bit higher typically?
Most of the times, yes.
Okay.
Because we've seen that is the only asset class which, technically, if you understand, would outbeat inflation in the long term.
Yeah.
But that does not take away the fact that diversification is not necessary out here.
Yeah.
And equity per se does that job for you. And the benefit of investing in equity-based products, so whether even you have the research and the wherewithal to invest in stocks on your own, pick up the right stocks. If you don't, then obviously mutual fund is the answer. And even ESOPs are a way of equity. You're buying into a company's own share as an employee there.
Yeah.
So even ESOPs is a part of equity for the long term. So equity is the way people would look at long-term goals.
Okay.
Yeah, but here I think I'll take the liberty, Avan, of making a differentiation between asset allocation and diversification.
Okay.
Okay, and not many people really harp into it. Okay, if I was in equity, and that is the go-to way for me, and if my 100% of money was in equity, I'm not talking about time frame here. I'm just talking of a asset class. If my 100% was in equity, many people would say that, I'm diversified. So he or she would say that I've got money in large caps, I've got money in mid caps, I've got money in small caps. Great. That's diversification in the same asset class.
Yeah.
That's not asset allocation.
Yeah.
So people
There's a
still
difference.
feel, and then they categorize the risks as well.
Yeah.
The textbook that large cap is less riskier and mid and small are higher. But boy, you are still in the same risk asset class. What asset allocation means, you are in a different non-relative asset class completely.
Yeah.
Which has got no correlation with the other one. Similarly, case could happen with a conservative investor.
Yeah, sure.
So he or she would say that I'm into government bonds and I'm into fixed deposits, I'm into corporate deposits, not understanding that you need to be in equity, which is a different asset class.
Yes.
So that's a small, I think.
No, it's important to understand the difference between the two. What would you say would be the pecking order of different asset classes when it comes to the ones that can best be a hedge against inflation?
Okay. So obviously equity takes the top slot. And in equity, like I mentioned earlier, I don't want to repeat it, that with whatever equity class you are comfortable with. Okay. But for a retail investor, obviously now the revolution we are seeing about mutual funds, I think that would be the way to go for a retail investor. Second, obviously, I would look at gold, because though as much as we've seen that, it gives conventional returns and all, but when you say long term and, an effort to beat inflation, I think gold is a better bet. And for whatever reasons, real estate could be a candidate for the third spot. But real estate, the only problem I have with real estate is it's still illiquid.
Okay.
So buying is easy, but probably when you get out of it, it might cause an hindrance to you. And I believe a lot that when you need the money, you should have the money. And there should be no delay in, getting that money. And many a times we've seen real estate causing problems for people at the last moment, when they require the money. But as an asset class, I think that stands also a good chance. But that's not shown up in the last 10, 15 years when we talk about real estate. But it's an integral part for people who have spare money after their entire financial planning asset schedule has been met.
Given that, the financial landscape is evolving, what are the key factors that people need to keep into mind before allocating to different asset classes?
Understand the risks.
Okay.
Which are in that product, not your own risk. That is the job of the financial advisor. Be financially, I would say, literate. I'm not saying graduate. So even that onus is on the individual now in today's world, that he or she should understand finance a little bit better, because it's a complex jungle and you are bound to get caught in wrong things. You are bound to get missold things. So that little bit of financial literacy needs to be had in every person on his own. It can't be taught every time. The initial, I would say, interest should be there in the person himself. So when you are setting out on that financial journey, do some homework yourself as well.
Okay. Thank you so much, Kalpesh, for joining in and sharing with us your thoughts. Been
Thank you.
very eye-opening for investors. And lots of key takeaways as well when it comes to personal finance. Stressing on the word personal is very critical. Asset allocation is absolutely the crux to achieving your long-term goals. You need to start tracking your expenses, putting pen to paper, understand your time frame and all of your goals is very important. Do remember to allocate to health insurance as well. That's very critical. Equities is usually for the long term, and asset allocation is different from diversification. That's also important to understand. Would love to know your key learnings from this episode. Do share with us in the comments section. And with that, we'll wind it down on this edition of this episode. Do remember to hit that subscribe button. Thank you so much for watching. I will catch you in the next episode.